Hello, everyone. Welcome back to another edition of the Week in Charts. Charlie Bilello here. I'm your host. As always, I'm going to take you on a tour of the markets and walk you through some of the most important charts and themes that I'm seeing today. Huge show for you. If you're watching this on YouTube, hit that subscribe button for more content just like it. What are we going to be discussing today? We're going to be talking about the Fed and expectations. People seem to be betting more and more on a September rate cut. I'll talk about some of the reasons why. The all-time high party continues in the U.S. equity market. Seems like every single day, new highs for the S&P 500. Investors are getting greedy. Not surprising to see some of the sentiment data getting frothy again. Apple's highest valuation ever. So historic number we hit in terms of price to sales ratio for Apple last week. We'll dig through the charts there. Tesla's incredible comeback. This is a stock that was down 40% plus this year, now positive year to date, just a huge comeback. A coordinated contraction. Well, that's some questions people are asking after we got the latest PMI data from manufacturing and services, both showing a slowdown below 50. More listings equal more price drops. So housing market, we're seeing a little bit of a shift here. We're rising supply and we're seeing more sellers cut their prices. And we'll end, as we always do, with something positive, and that would be cheaper rents, asking rents falling once again on a year-over-year basis. So let's dig in, start out with those Fed rate cut expectations. Investors are betting more and more on that September cut. You can see here, 78% probability of a rate cut in September. That's up from 64% a week ago and just 50% a month ago. So pretty big shift there. We're talking about a coin flip in terms of the cut a month ago, and today getting closer to that 80% number. And why are investors saying the Fed is likely to cut in September? I would say four big reasons we're looking at. Number one would be unemployment and the fact that it's moving higher. You can see 4.1% now. That's the highest we've seen since November 2021. And the Fed has a dual mandate. So they're looking at maximum employment. They're looking at stable prices. And for the past few years, of course, the pricing side, much more important because inflation got out of control, got up to 9%. Today, inflation, we're still above 3%, but we're starting to have more of a concern about employment here with the unemployment rate rising and hitting 4.1%. And I'm updating this chart here. It's an interesting look historically at what has happened in the past in terms of the economy when we've seen a 0.7% rise in that unemployment rate. So we hit the cycle low back in April 2023 of 3.4%, and now we're at 4.1%. And what has happened in the past when we've seen a 0.7% increase, you can see we're pretty close to recession. Actually, on average, we're already 2 months in a recession. Now, every time is different. Doesn't mean that there's going to be a recession necessarily in the next few months, but you can see here historically, pretty solid indicator of economic weakness. So certainly the Fed is going to be looking more at the employment side. If this continues to increase, you're going to see increasing pressure from the Fed to start cutting rates. And if we look at the payroll gains, you can see here still jobs growth. So it's not like we're seeing job losses. Over 200,000 jobs were created last month, 42nd consecutive month of jobs growth. But the evidence is showing that the jobs growth is slowing here. So if we're looking at the year-over-year change in the number of jobs in the U.S., we're looking at a 1.7% increase, and that's the slowest growth rate since March 2021. So that would be reason number two, that the Fed is looking at this and saying, well, the pace of jobs growth is slowing. That means the labor market is cooling, and perhaps we need to start leaning on the side of easing again. And number three would be the big factor here of wage growth. So for a long while here, the last few years, higher inflation has meant higher wages. And it's kind of been a spiral, a wage price spiral, where companies are increasing wages, then they're increasing prices, and so on and so forth. And you can see here, we now have 3.9% increase in hourly earnings over the last year. That's the slowest growth rate since May 2021. So this is showing you that the labor market seems to be cooling. That big imbalance between the supply of labor and demand of labor that we were seeing for a few years, well, that seems to be normalizing here. And if this continues to move lower, the Fed likely more and more confidence in terms of cutting rates. Finally, you have the inflation factor here. And this is the big one that the Fed looks at, which is core PCE. And you can see the trend here over the past few years. 2.6% was the last reading we got, which was the lowest since March 2021. So if this continues to move lower, you're going to have the Fed increasing their likelihood of a cut. And if we're looking at real-time inflation gauges, Trueflation puts out this real-time inflation number, and what they're saying is inflation is actually below 2% at this point, 1.9%. If we compare that to what the last CPI reading was, 3.3%, you could see significantly below it. So I don't know if the Fed is looking at things like this or real-time data, but they probably should be. And this is just yet another reason I would say that the Fed has increasing odds, not at 100%. We still have a lot of time between now and September. So we could see any of these data points get move in the other direction. Well, that's going to lower the odds. But as it stands today, becoming increasingly likely that we're going to see a rate cut this year. Number two, the all-time high party continues. So the fascinating thing is that market participants were saying for a long time that higher rates were going to be bad for the stock market and that the S&P 500 was going to get hurt and stay down after the Fed hiked rates 525 basis points. So we went from essentially zero on the Fed funds rate to 5.25 to 5.5%. And you can see here the S&P 500 on the top chart here doesn't seem to have minded those higher interest rates. In fact, the S&P 500 is 28% higher than where it was when the Fed started hiking rates in March 2022. Now, that's interesting to me because a lot of people saying that the market's getting excited about the Fed cutting rates in September, but higher interest rates don't seem to have hurt the stock market. So why should investors be getting so excited about lower interest rates? You can see this year, despite the Fed funds rate being above 5%, despite monetary policy being tight, the S&P 500 has already hit 34 all-time highs this year alone. And that's on pace now to be the third most in history if it were to continue at this pace, which of course, no guarantee of that, but that would only trail a year like 1995, which was one of the most incredible uptrends we've ever seen, and 2021, another year with very low volatility and just kind of a smooth uptrend throughout the entire year. So we're on pace for historic territory here in terms of the number of all-time highs, 34 already, and we're only in early July. If we look at that chart, in terms of the best starts to a year in history, you can see we're moving up now to number 12 on the list. S&P 500 up 16.7% this year. And again, we're only in early July. This is now the best start to a presidential election year that we've ever seen in history. And is this lifting all boats? This has been the big overhang. Everyone's questioning the rally because we're not seeing everything participating. Hasn't been a rising tide that has been lifting all boats. It's lifting the broad index, the S&P 500, but not lifting things like small caps. You can see here the huge divergence we have year to date between the S&P 500 ETF. This is a total return, including dividends, up over 17% now year to date. And the S&P small cap ETF still down 2%. So huge spread. You rarely see this enormous spread in terms of large versus small. We haven't seen a spread this wide since 1998, and historically, very rare to see this type of divergence with large caps doing so well and small caps down on the year. And what that's done is push that ratio that we've been looking at of large caps to small caps up to its highest levels since October 31st, so Halloween in 1999. You got to go back a long time to find the outperformance of large caps over small caps this stretch. And I've talked about in recent years what happened following the 1999 period. Well, it was a period where U.S. large caps would go on to underperform small caps over the next 7 years by a wide margin. Let's look at the enormous eight here. These are the biggest stocks in the market, get the most attention in the market. And you can see having another incredible year. Last year, all of these stocks were outperforming the market by a wide margin. And this year now, all except for Tesla are now outperforming the S&P 500. You can see that big spread between these names, and small caps down 2%. So huge divergence. You got Nvidia up 154%, Meta 53, Netflix 42, Google 37, Amazon 32, Microsoft 25. We're talking about a little over halfway through the year, and these enormous numbers for the biggest stocks in the market. And most of these stocks would be considered growth stocks. They're in the growth stock category. And what that's done in terms of the spread between growth and value, well, it's pushed it up to another extreme here. Now looking at the highest spread between growth and value that we've seen since March 2000. And March 2000 rings a bell. That would be because that was the peak of the dot-com bubble back then. The peak in terms of these high growth tech stocks occurred in March 2000. Also was the peak of the S&P 500 index as well. And now we're at levels that we've only seen in March 2000. Does that mean we can't continue to see growth outperform value? No, there is no impossible. Certainly can go higher, but certainly stretched if we're looking at the last 40 years. We're at the highest levels with the exception of that March 2000 peak. So at a time like this, it's important to take a look at your portfolio, make sure you're properly diversified and positioned for the future. At Creative Planning, we can help you with all of that. Take a look at the show notes. I'll have a link to get a free wealth path analysis from Creative Planning. What is that going to do for you? It's going to give you a number of things. You're going to get a free portfolio checkup, looking at your entire portfolio, seeing if there's any opportunities to eliminate high fees, if there's tax loss harvesting opportunities, and much more. We're going to take a look at your retirement planning and make sure you're on the right path in terms of having a good roadmap, you're in good shape. Tax planning, we have a number of CPAs at Creative Planning. We'll take a look at your whole tax situation, see if you should do a Roth conversion, asset location, are you holding the right assets in the right accounts? And finally, estate planning, hugely important topic. Do you have all your affairs in order? So take a look at the show notes for a link to that free wealth path analysis. We're in all 50 states at Creative Planning, over 300 billion assets under management and advisement, and we're here to help. Number 3, investors are getting greedy again. We have this sentiment data that seems to get frothy every time the market's surging higher, and it's happening once again here with the S&P 500 above 5,500. Investors Intelligence, this is looking at newsletter sentiment. Percentage of bulls now 63%. That's the highest we've seen since April 2021. And if you remember 2021, it was a period of just complete euphoria in the markets where we had the IPOs rushing in, the SPACs rushing in, we had a crypto mania, we had a number of things going on with the meme stocks, and now the percentage of bulls looking at sentiment is at the highest level since back then, and of course significantly higher than what we saw in October 2022 at the bear market lows. So stock market's up over 50% since then, and investors getting much more bullish. And if we look at active managers here at this chart here, looking at their exposure, active manager exposure above 100%. So they're using leverage long once again. And you can see the opposite of what they were positioned last October when we had that correction in the markets. So sentiment getting a little frothy again, as expected. You would expect that with the markets doing as well as they're doing year to date. Certainly investors getting more and more bullish because of that fact and because of the narrative around AI. But just important always to remember that sentiment is looking at the past. Investors are reacting to past price performance, and what tends to happen when you're at extremes is you tend to see below average returns going forward when you have these types of sentiment extremes. Number 4, Apple's highest valuation ever. And this is pretty incredible that we've hit this point here with Apple actually showing negative revenue growth over the past few quarters. And despite this, investors looking, I guess, ahead to the future and assigning Apple with its highest valuation in history here, looking at the price to sales ratio of Apple crossing above 9 times sales for the first time. And you can see the shift over the past few years. January 2019, just a few years ago, this stock was trading at 3x sales. Today, over 9x sales. So expectations very, very high for Apple. And if we look at other metrics here, you can see Apple's PE ratio 35 times, EV to EBITDA 27 times, and you can see much higher than the average that we've seen over the last 10 years. So certainly trading on the rich side of things, and investors seem to be expecting huge things to come from Apple. Last few quarters, as we talked about, negative year-over-year revenue growth. So perhaps investors are saying they're going to turn that around. We're going to see big growth numbers to come, but definitely on the higher end of the valuation spectrum. And Apple's not alone. If we look at other big tech names, look at the biggest growth stocks in the market, you can see none of them trading on the cheaper end of things. Of course, Nvidia at the top of the list, but you have stocks like Tesla, Amazon, Netflix, Microsoft, 40 times earnings, and the price to sales ratio all well above market multiples and well above where these stocks were trading on average in the last 10 years. So you have that combination of sentiment driving this, you have that fundamental performance, but this is way beyond this. This is a narrative play now. This is a narrative story that we're going to see AI really deliver in terms of the fundamentals in the quarters to come. And whether that happens or not, we've seen it happen with NVIDIA. We haven't seen it with these other stocks. If that doesn't happen in the next few quarters, you're setting up, I think, for a big disappointment because the expectations are just getting higher and higher here. And talking about expectations, Tesla, just incredible comeback. Expectations were, of course, very, very low for Tesla just a few months ago. And we were talking about the longest drawdown in Tesla's history. It's still in a drawdown today, but what an incredible turnaround it's had this year. Of the enormous eight, Tesla was really a standout on the downside. Everything was kind of doing well in April, except for Tesla, but that has shifted here. You can see it was down over 40% at its low on April 22nd, and it's rallied 77% from that low to cross into positive territory for the year. And so what we saw last week was an enormous surge higher. Stock was up well over 20% on the week. And the only big data point that we got last week was on the delivery numbers. I wouldn't say they were outstanding, but they were better than expected. Expectations were so low that I guess this was enough of a beat. Close to 444,000 deliveries in the second quarter, and the expectation was for 439,000, but still down 5% year over year. So expectations are everything. Expectations were very low. Tesla was running, heading into this delivery report, was running higher, and this kind of gave it another surge higher. We'll see what happens with earnings, and the reaction to all of these companies' earnings, I think, is going to be telling in terms of the expectations, and see were they too high for those other growth stocks. And for Tesla, after this advance, is it going to pull back again? Let's say if we get another poor earnings number. That has been the story for Tesla the last few quarters, having difficulty after reporting margin contraction and slower revenue growth. Coordinated contraction in the economy. So what a interesting divide we have now between the stock market, which is going gangbusters, and the economy and some of the economic data, which seems to be showing a little bit of a slowdown here. If we look at manufacturing PMIs, and this has been a trend for a while now, so nothing new here, but down below 50 for 19 out of the last 20 months. That is, you have to go back a long time to see a streak that long below 50. And below 50 simply means that these companies that they're surveying are saying the economy is contracting if we're below 50. And 19 out of 20 months, we haven't seen that. Only two other times in history. One would be 89 to 91. And of course, there's a recession in there, and the other 1981 to 83 recession in there as well. So definitely manufacturing economy is in a downturn, but the bright spot had been the services sector, which was above 50, but now dropping below 50, lowest since May 2020 at 48.8. And what we have here is a combination of the two below 50, which has been pretty rare going back to 2008. We really only saw it during the 2008-09 recession, briefly in 2020 during the COVID recession, 2022. We saw it for 1 month in December 2022, and we saw it in April of this year, and then again in June. So interesting. We'll see if this continues. Certainly, the services sector being much more important today than the manufacturing sector. But if this were to continue to decline, I think that's going to put increasing pressure in terms of the Fed. Just yet another data point to suggest perhaps they should start cutting interest rates. And if we look at Atlanta Fed GDP, their real-time estimate for the second quarter, you can see here it moving lower. It was 3% just a few weeks ago. Today we're at half of that. Now they're expecting 1.5% for that real GDP number. So very different than the stock market. We're seeing this economic data start to trend lower. We talked about rising unemployment rate, talked about slower jobs growth, slower wage growth, and now we're seeing the data in terms of the manufacturing and services PMI both below 50 at the same time. So it's starting to pile up this evidence of a slowdown. Doesn't mean a recession. Certainly 1.5% is not negative, still positive, but we're trending in a slower direction. Look at the housing market. We've seen a big shift over where we were the past few years, and past few years were historically a huge anomaly in terms of the number of homes for sale. Just an extreme shortage in terms of the number of homes that have been available for sale, and we're finally seeing that turn around here with increasing number of listings. And what that's causing is sellers to cut their prices, because you have houses staying on the market for longer. They want to sell the house in this seasonally strong period. You certainly want to try to sell the home in the summer months. Once you get to the fall and winter, it becomes harder and harder to sell. And what we're seeing is the highest percentage of price drops from sellers, 6.9%, the highest on record. Redfin's been tracking this since 2015, so not a long data set, but the highest we've seen since at least 2015 at 6.9%. And if we're looking at the listings data here, you can see 18% increase in housing inventory over the last year in terms of the number of homes for sale. That's the highest we've seen since 2022. And I suspect as we get into the late summer and the fall, when you tend to see listings continue to increase and build up into that period of time, I suspect we're going to pass those levels from 2022, and this supply is going to continue to build. And why I suspect that is because of the affordability equation that we've been talking about. Prices still very, very high, mortgage rates still high. That means houses unaffordable for most people, and with prices remaining high and asking prices high, even with those price cuts, it's not enough to take down this inventory. So as the number of listings continues to build, we're going to see, I think, more pressure on sellers to cut prices, and perhaps we'll start to see that the home price appreciation gains start to slow as we go into the fall and the winter. So I want to end, as we always do, with something positive, and that would be cheaper rents. This has been a theme month after month, but great news. Opposite of the market to buy a home, if you're looking to rent an apartment, very different story here. And if we're looking at new apartments, you can see that in the data here. New apartments are actually filling up in the slowest pace we've seen since 2020. You can see the Redfin has this data since 2012, and 47% of these new apartments were rented within 3 months of completion. So having a more difficult time renting these new apartments. And the reason for that is there's more supply than there is demand. And you can see here, there was a lot of multifamily building in recent years. So unlike the market for homes, in terms of new homes and housing starts, which really has not picked up enough, the market for multifamily housing and apartments, we've seen a lot of construction. So we're seeing much more supply here. We saw just a huge surge in terms of construction completions in 2022 and 2023. And what that's leading to is an increase in vacancy rates here. You're seeing 6.7% vacancy rate. That's the highest since August 2020. And what that's doing is changing the dynamic between landlords who are renting their apartment and renters are coming in, and the renters are increasingly having the upper hand. So if we're looking at asking rents here, they're actually down 0.7% over the past year. That's the 13th straight month where we're seeing a year-over-year decline. So big difference than the home prices, which are still going up at 6 to 7%. In most places, year over year, we're seeing actual rents now down 0.7%, 13th straight month of year over year decline. And again, the CPI data is reflecting this with a lag. So this is good news. If you're looking at the next CPI report, we should see that shelter CPI number continue to trend lower and likely see a lower number for CPI, which will come out later this week. So huge benefit for a lot of Americans who are in the rental market, where they're waiting to buy a home, they're saving money, housing prices are unaffordable. Well, each and every month that rental prices don't go up and your incomes go up, well, that's making that monthly rent much more affordable. And hopefully this continues and this supply situation really holds prices down and allows people's incomes to catch up with this huge rent increase that we saw in 2020, 2021, and early 2022. All right, so we'll end it right there. Thanks everyone for joining me. If you're watching this on YouTube, hit that subscribe button. Have a great week, everyone, and I'll see you next time on the Week in Charts.